Welcome to Breaking News to Trading Moves. We are here to strip away the noise, look at the headlines actually moving the markets, and crucially identify the winners and the losers based on the data.
It's good to be here.
We are not here to speculate on rumors. We are here to look at the hard numbers and the mechanical flow of capital.
And earnings season is, it's the perfect time for that. You get so much noise, so many numbers flying around.
Right.
But then every once in a while, you get a report that just, acts like a Rosetta Stone. It translates all the whispers and theories into actual concrete evidence.
And I think that's exactly what we have on the table for this discussion. We're looking squarely at the semiconductor sector.
A critical area of the market right now.
Our focal point is the recent reporting from Applied Materials. The ticker symbol there is AMAT.
AMAT. A real bellwether for the entire industry.
So on the surface, the headline seems pretty simple, right? Applied Materials, they've forecasted their second quarter sales above estimates.
That's the top line, yeah.
But I have a feeling the why behind that number involves a lot more than just, selling a few more machines. We need to understand the texture of this report.
The texture is everything here. And to really get the downstream trading moves, we first have to look at what AMAT actually reported.
Yeah.
So they had a Q1 beat. That's fine. It's good. But it's in the past.
Right. The market's already moved on from that.
Exactly. The market is a forward-looking machine. So what really matters is the guidance they gave for the second quarter.
And that guidance was, well, it was robust.
It was. Both their revenue and their adjusted earnings per share, or EPS, came in above what Wall Street was projecting.
Okay. And whenever a major equipment supplier like Applied provides guidance that goes beyond expectations, you have to ask the next question.
Who's buying?
And what are they building?
Exactly. Because you have to remember, Applied Materials sits at the very, very start of the food chain. Nothing gets built, not a phone, not a car, not a data center, until their tools get installed and turned on.
So what did they cite specifically? Was this a case of a broad-based recovery where, everyone is buying everything, or was it much more targeted?
It was highly specific, and that distinction is vital for our analysis today. They didn't come out and say the chip market is back.
No vague statements?
No. They said the guidance is being driven by accelerating investment in AI compute. That's the primary engine.
AI compute?
But, and this is critical, they also pointed to a very tight memory supply. They specifically called out DRAM and HBM, which is high bandwidth memory.
Okay, so the two main drivers are AI compute and memory. That's what's pulling the demand.
Correct. But they added two more pillars that are just as important for the technical setup. They mentioned strength in leading-edge logic and strength in advanced packaging.
I want to pause on that term, advanced packaging. We keep seeing this pop up in reports from all across the sector.
It's everywhere now.
For the listener who might think of packaging as just, the little black plastic shell that a chip sits in, can you explain why this is suddenly moving stock prices?
It's a great question because it used to be just that, just the plastic shell. But in the AI era, packaging is where the performance bottleneck is being broken.
How so?
Well, you see, we're kind of hitting the limits of physics when it comes to shrinking transistors on a single flat piece of silicon. So the industry has had to move to stacking.
Vertically.
Exactly. You have to stitch different chips together, either side by side or on top of each other, to get that massive AI performance that's required for, say, training large language models.
So packaging has really become about 3D construction.
Precisely. It's all about vertical scaling. And doing that requires incredibly complex, incredibly precise tools. You're bonding silicon to silicon with microscopic accuracy. And that, of course, requires the specific tools that a company like Applied Materials sells.
Which brings us back to why the market treats this one report as such a clear signal for the whole industry. It basically functions as a read-through for the entire semiconductor capital expenditure cycle, the whole CapEx story.
That's it exactly. If Applied is seeing orders spike for these specific tools, it implies that the fabrication plants, the fabs, are expanding their capacity.
They're spending money, big money.
And the report highlights several specific technical segments where this spending is landing.
Yeah.
You've got etch, deposition, metrology, inspection, and of course packaging.
Okay, etch and deposition. It sounds like a geology class.
It's not far off. It's basically geology, but at an atomic scale. Think of deposition as a sort of 3D printer that lays down layers of material just a few atoms thick.
Okay.
And then etch is the sculptor. It comes in and carves away all the excess material to create the tiny transistor structures. If you're building the most advanced AI chips, You need the most advanced sculptors and printers on the planet.
And then the other two you mentioned, metrology and inspection.
That's your quality control. 100%.
Yeah.
When you're building these incredibly complex 3D structures, you can't see the defects with the naked eye or even a normal microscope.
Right.
You need machines that use, say, electron beams or lasers to measure everything, that's metrology, and find any defects, that's inspection.
So the logic here is pretty straightforward then. If the demand for the final products, the AI and memory chips, is going up, then the utilization of these tools has to go up as well.
That is the mechanic. It drives orders for new equipment, it increases the utilization rates of the equipment that's already in the fabs, and crucially for investors, it tends to improve pricing power.
Ah, pricing power.
When everyone needs the best tools right now to compete in the AI race, AMT and their peers don't have to offer a discount.
That sets the stage perfectly. So we have the headline, AMAT beats and raises guidance based on this very specific AI and memory demand. Now, let's move to the trading moves. Who benefits? Let's start with the first category, the winners. And first up is wafer fab equipment and process control.
This is the most direct correlation you can draw. It's often called the picks and shovels trade.
The one selling the tools to the gold miners.
Exactly. As we just established, when memory and logic foundry capex expands, the fabs are required to go out and purchase more of these tools, the deposition tools, the etch tools, the inspection and metrology tools.
And obviously the first winner here is the subject of the news itself.
Yes, AMAT, Applied Materials. They are the primary beneficiary because this is their report, their guidance, they're kind of the general store for the industry. They sell a bit of everything.
But they don't operate in a vacuum. There are peers in this space that move in sympathy with this kind of news.
Oh, absolutely. The first name you have to look at is Lam Research. The ticker there is LRCX.
LRCX. Okay, so why them specifically? How are they positioned?
Because Lam is very, very heavily involved in those etch and deposition steps we just talked about. In fact, you could argue that Lam is even more leveraged to the memory cycle than Applied is.
More leveraged how?
They're a specialist.
Yeah.
Especially in the vertical stacking that's required for things like 3D, NAND, and HBM. So if the memory makers are out there buying new tools to deal with this shortage, LRCX is right there on the receiving end of those purchase orders.
Okay, so that's a direct link. And there's another name that's often grouped in here.
There is KLA. The ticker is KLAC.
KLAC.
And they're absolutely dominant in that process control sector we mentioned, specifically inspection and metrology.
The quality control guys.
The quality control kings.
So why does the AI angle, in particular, help a company like KLA?
It's about risk and money. AI chips are massive. Physically, they are very large pieces of silicon, and they are incredibly expensive to manufacture. A single wafer of these processors can be worth a fortune.
So if you mess one up,
If you ruin a whole wafer of AI chips because of a microscopic dust particle or a tiny misalignment in the process, you have just lost a substantial amount of money. The yield, which is the percentage of good chips you get from each wafer, is absolutely critical.
so the fabs, they need insurance.
Exactly. KLC sells the insurance. The more complex the chip gets and the more layers you have to stack on top of each other, the more you absolutely need to inspect it at every single step to make sure it works.
So as complexity goes up, the need for KLA's tools also goes up.
It goes up proportionally.
Yeah.
Their intensity in the fab, as they say, increases.
So to sum up this first group of winners, AMAT, LRCX, and KLAC, this is the first cohort, the tool makers.
That's the logic. It all starts with upstream demand for their tools.
All right, let's move a little further down the stream. The second segment of winners, the AI, compute, and accelerator ecosystem.
Right, so this moves us from the tool makers to the actual chip designers. The demand signal that Applied Materials is seeing is ultimately just a reflection of the end users buying more and more AI processors.
Can you explain the operational link here? How does AMAT's guidance really validate the thesis for these other companies?
It all comes down to confidence. Confidence in the duration of this cycle. Investors, they're constantly worried. Is this AI spending a bubble? Is it going to stop next quarter? Is the demand real?
Is it real and is it sustainable? And when a factory operator commits billions of dollars to buy new tools from AMAT, they are not doing that based on a short-term blip in demand.
No, that's a multi-year bet. They're putting real capital at risk.
Exactly. So stronger demand signals for these AI processors, they pull through more leading-edge wafer starts. That's the industry term. You can't have the chips without starting the wafers.
And it also pulls through demand for the other area we mentioned.
It does. These powerful chips require that advanced packaging capacity we talked about. And there's the supply chain pressure aspect as well, especially with memory.
Right.
This whole AI build-out keeps a ton of pressure on the memory supply chain. These accelerators, these GPUs, they need massive amounts of high-speed memory to function.
You can't run a large language model on a processor alone.
No, it would
Yeah.
be like having a supercar with a tiny gas tank.
Yeah.
It needs the memory to constantly feed it data. So the health of the equipment supplier basically confirms the health of the demand for the accelerators themselves.
Mhm.
The tickers here are probably the names most people associate with AI compute.
First and foremost, you have the leader, NVIDIA, ticker NVDA.
NVDA.
They are the primary driver of this AI compute demand. I mean, if AMAT is telling you they're selling more tools for AI compute, they're effectively telling you they're selling tools to foundries that are building NVDA products.
And the second name in this bucket.
AMD, ticker AMD. As a key player in this accelerator ecosystem, they benefit from the exact same demand signals.
They're the main challenge.
They are. And as the market for these chips expands, customers are actively looking for second sources. AMD is ramping up their own AI offerings, and those offerings require the exact same leading-edge manufacturing and advanced packaging capacity.
So let me just rephrase to make sure I've got it. If AMAT says we're selling more tools because people need to make more AI chips, the market reads that as people are buying more AI chips from NVDA and AMD.
Precisely. It validates that the end market demand is real, it's strong, and it's growing.
Okay, that makes sense. Let's move on to the third segment of winners. This one is the memory supply chain beneficiaries.
This was a really critical part of the AMAT report. They didn't have to call this out, but they did. They specifically cited tight memory supply.
Yeah, they mentioned a global memory shortage.
They did, and they got even more specific, focusing on high bandwidth memory, HBM, and DRAM.
I want to dig into the market mechanics here a little bit.
Right.
Why is a shortage actually good for these companies? I mean, usually you want to sell as much volume as you possibly can.
It's a bit counterintuitive, but in the memory market, it's all about the supply-demand balance. Memory is essentially a commodity.
Like oil or wheat.
Very much like oil or wheat in how it trades. When there is a glut of supply, prices just crash, and these companies can lose money even if they're selling a lot of bits. But when there's a shortage, that's when pricing power comes roaring back.
Okay, so why is there a shortage right now? What's causing it?
It all comes back to HBM, that high bandwidth memory. Making HBM is extremely difficult. It's complex, it has lower yields, and it eats up a lot of wafer capacity at the fabs.
So a wafer that's used to make HBM can't be used for anything else.
That's the key. It can't be used to make standard DRAM. So as the entire industry rushes to build more HBM to supply the AI accelerator companies, they're effectively starving the market for standard memory.
Which lowers the overall supply, even if total production is high.
Right. Tighter supply leads to firmer pricing. And to meet that supply, you see higher utilization rates at the factories, which makes them much more efficient.
And firmer pricing, of course, is generally very good for the manufacturer's bottom line.
It's the primary lever for profitability in the memory sector. A small increase in price can lead to a massive jump in profit margins because their fixed costs, the factories themselves, are already paid for.
So who are the specific tickers that fall into this bucket?
Well, the name to watch here is Micron, ticker MU. They are a direct beneficiary of this pricing power in both DRAM and HBM. They're one of only 3 companies on Earth capable of producing these most advanced memory chips at scale.
And who is the other main player here?
Western Digital, ticker WADC. They also benefit from these dynamics of tight supply and firmer pricing in the memory market. Now, they also have a large business in flash memory, or NAND,
Right.
but generally, a rising tide in memory pricing tends to lift their boat as well.
Okay, so MU and WDC round out our winners bracket. We have the tool makers, the AI chip designers, and now the memory manufacturers.
All connected by that single thread of increased AI and memory demand that was signaled by AMAT.
So now we have to look at the other side of the ledger, the losers. And I want to be clear here, when we say losers, we're talking about the specific trade setup relative to this news.
Right.
We're not saying these are bad companies or that they're going bankrupt.
No, not at all. We're talking about potential margin pressure and relative stock performance in the wake of this news.
Okay, the first group here is PC and consumer hardware.
And this is where we see the exact inverse effect of what we just discussed with the memory companies.
We just talked about how firmer memory pricing is great for Micron and Western Digital.
Right. But for the companies that have to buy that memory to put it into their products, firmer pricing represents a higher cost of goods sold, a direct hit to their input costs.
This is the classic bill of materials issue.
Exactly. Think about a laptop or a server. Inside that chassis, the memory and the storage are two of the most expensive components right after the main processor and the screen.
So if the price of DRAM goes up by, say, 20%, the cost to build that laptop goes up.
It has to. The vulnerability here is direct exposure to higher memory costs. If DRAM and HBM supply stays tight, those component costs are going to rise.
And what does that do to the business model of a hardware maker? I mean, can't they just pass that cost on to the customer? Can they just make the laptop more expensive?
Yeah, and that's the problem. The outline notes that passing through these costs is often very difficult in what are called competitive end markets.
Can you explain that dynamic a little more?
Well, if you are selling enterprise servers or consumer laptops, it is an absolutely fierce market. There is not a lot of pricing power. So if Dell raises their prices by $50 to cover the higher memory cost, and HP decides to absorb that cost to gain market share,
Dell loses the sale.
Dell loses the sale. They're stuck between a rock and a hard place.
So they often have to just absorb the cost increase themselves.
More often than not, yes. And if your costs go up but your selling price has to stay the same, your profit margin gets squeezed. It's simple math.
So who are the tickers that are facing this particular risk?
The first one is Dell Technologies, ticker DELL.
DEL.
As a major manufacturer of PCs and servers, they are a massive consumer of memory. Now, their server business is doing very well with AI, but the rising cost of components is a clear headwind for their margins across the board.
And the second one?
HP, ticker HKQQ, they face the exact same dynamic. They're heavily exposed to the PC market and the printer market. Higher input costs for their hardware products without the ability to easily raise prices is a very tough setup for them.
So DELL and HPQ are potential losers here because their essential inputs are just getting more expensive.
That's the logic. One man's price hike is another man's margin compression.
All right, let's move to the second group of potential losers. This one is China-sensitive semiconductor exporters.
This is a much more nuanced category. Here we are looking at a very specific risk factor: policy and compliance overhang.
And it's noteworthy because some of these companies, we actually listed them as winners just a few minutes ago.
Yes, and it's so important to understand that duality. A company can be a winner on the technology thesis, but at the same time face major headwinds on the geopolitical thesis.
So even with the strong global demand we've been discussing, this acts as a kind of counterforce.
It does. Export controls, they effectively put a limit on the total addressable market for these companies.
Can you explain what's meant by headline risk in this context?
Sure. The U.S. government has very strict rules on what level of semiconductor technology can be sold to China. Compliance scrutiny from regulators can limit sales volume at any time. There are strict limits on how much these companies can sell into restricted customers or restricted regions.
So even if there is real demand in China, say a factory there wants to buy a tool and has the cash ready to go, the U.S. company might not be allowed to ship it.
Exactly. It creates a ceiling on their performance in those specific geographies. And for investors, there's always the worry that the rules could tighten even further at any moment, with very little warning.
The tickers here are the tool makers again, then.
Yes. Applied Materials itself, ticker AMAT. Despite their great guidance, they face this specific risk. A large portion of their historic revenue has come from China. As those spigots get turned down or monitored more closely, it acts as a drag on their potential growth.
And their primary peer.
Lam Research,
Right.
ticker LRCX. They also have considerable exposure to these export control dynamics.
So for both AMAT and LRCX, the bullish case is this global AI-driven demand, but the bearish risk factor is the trade restrictions.
That is the balance that investors have to weigh. You can't just look at the order book. You have to look at who is actually allowed to receive those orders.
Okay, that's clear. Finally, let's look at the third group of losers, legacy and low-growth semis.
This category is really defined by what it is not. These are the segments of the semiconductor industry that do not really ride the AI CapEx wave.
We talked about capital concentration earlier. It really feels like all the oxygen in the room is being sucked up by AI right now.
That is a very fair assessment. Both spending from customers and attention from investors are concentrating on three very specific areas. 1, AI compute. 2, leading-edge logic. And 3, advanced packaging.
So if you're a company that's not in one of those three buckets, what happens?
The old economy chips, or the slower growth segments, they tend to lag in relative performance. The capital just isn't flowing there with the same velocity. The fabs are prioritizing their spending on the high-margin AI tools, and that means they're potentially delaying upgrades for their older legacy nodes.
So these companies might be doing just fine fundamentally, but relative to the AI group, they're losing momentum.
Correct. It is a story of relative lag. If the broader market is rallying on AI news, these stocks often just sit still or even drift lower as money rotates out of them and into the hot AI trade.
Who are the tickles that have been identified here?
The first one is Texas Instruments, ticker TXN. Now, they are a giant and a very, very well-run company, but their business is heavily exposed to industrial and automotive legacy nodes, things like analog chips and embedded processors. They're not necessarily part of this leading-edge AI wave we're discussing today.
And the second name here?
On Semiconductor, ticker ONE. It's similar dynamic. They're a big player in power and sensing chips, which are vital for things like electric vehicles and industrial applications. But right now, the automotive market is definitely softer than the AI data center market.
So TXN and ON represent the parts of the market that are not the current focus of this CapEx explosion.
Exactly. You could say they're watching the parade go by, so to speak.
Okay, let's try to summarize this. There are a lot of moving parts here, all derived from this single report from Applied Materials.
It all stems from AMAT forecasting strong sales. And that, in turn, signals a boom for the tool makers like AMAT itself, LRCX, and KLAC.
And it also confirms the powerful demand for AI chips from the designers, NVDA and AMD.
At the same time, it suggests a period of tighter supply and higher prices, which is great for memory makers like MU and WDC.
But on the flip side, those same higher prices hurt the margins of the hardware makers like DELL and HPQ.
And all the while, policy risks remain a persistent shadow for the exporters. And the legacy chip companies like TXN and ON are facing a comparative lag as all the capital chases the AI dream.
That's the breakdown. High demand in AI and memory creates pricing power for some, but it creates cost pressures for others. One headline, multiple trading moves.
That's the central theme. The market is an interconnected ecosystem. You pull one thread like an earnings beat at Applied Materials, and you can feel the tension move through the whole web.
Before we sign off, we must state the following disclaimer. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
We will see you next time.